Is the SBI Saral pension plan relied upon to have a golden retirement life? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So this is a single premium, individual, non-linked, non-participating, immediate annuity product. Some of the key features of the policy are: this is a single premium plan and you can choose your annuity mode at inception, and you can also use your life cover individually, or you can choose to cover your spouse as well in the joint life option. And there is steady cash flow available throughout the life of the annuitant, and the purchase price, which is the premium paid, is returned to the nominee or legal heir, and you have the option to avail the loan facility in case of any emergency financial need, and you also have the option to avail the surrender facility on being diagnosed with a specified critical illness. So these are some of the key features of the policy, and there are two annuity options, which are: first, life annuity with return of 100% of purchase price; second is joint life last survivor annuity with return of 100% of purchase price on the death of the last survivor. Now let us take a look at some of the advantages of investing in this policy. So the advantages are: there is regular cash flow, which is similar to salary structure, is paid to the policyholder during the post-retirement period. And it has a hassle-free investment structure where there is a lump sum investment option, which is a one-time premium payment option, and you can avail the loan option after 6 months, and you also have the option to surrender your policy after 6 months in case of any critical illness being diagnosed. And the return of purchase price is also an inbuilt feature in this policy, which acts as a legacy to the nominee or legal heir. So these are some of the advantages of this policy. However, the disadvantages are: though the income is regular, the return on investment is not on par with other fixed income products which is available in the market. The annuity amount is constant throughout the policyholder's lifetime, which may not be sufficient to meet the rising expenses down the lane. The annuity is taxable at the individual's higher slab rate. Annuity is fully taxable, so any annuity purchased directly other than proceeds of any pension plan like superannuation becomes taxable under the head income from other sources and not salaries, therefore not eligible for the standard deduction. So these are also some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, if you want to understand more about these aspects of the policy in detail, you can refer to the policy brochure. So now, as we have a basic understanding of this policy, let us move on to the analysis part of the video, where we are going to first calculate the internal rate of return and then compare it with other alternate investment returns to see whether which one gives you a better return in the long run. So let us first calculate the IRR for both the annuity options presented under this policy. So let us assume the annuitant age to be 60 years and the life expectancy to be 85 years. Now let us see the IRR for both the annuity options for the policyholder by being assumed these two things. So the IRR works out around 6.13% to 6.05%. So for both the annuity options, the IRR works out to be around 6%, which is similar to the bank FD rate for any individual. The bank FD rate for senior citizens is higher than this rate. So from the taxation point of view, the FD interest and the annuity both are taxable. So a deduction of up to 50,000 rupees on interest received from the bank savings account, and also senior citizens can claim FDs under Section 80 TTB. Also, the bank FD can be easily liquidated. So, in the rising interest rate scenario, locking funds for the long term at this rate of return in this policy is not advisable. So as the annuity is perpetually fixed till the lifetime of the annuitant, let's compare it with other fixed income options like Senior Citizen Savings Scheme, Pradhan Mantri Vaya Vandana Yojana Plan, RBI Floating Rate Bond, and Bank FD. So all the average return, how much tenure, the frequency, maximum investment, minimum age at entry, tax benefit, annual interest, taxation, every aspect of these options have been laid out in front of the screen in a concise tabular column which you can pause for your easy reference and see. So from this tabular column, what we can understand is that it is clear that the government backed schemes with the same fixed income options can give you better returns compared to the SBI Life Saral pension plan. So this policy doesn't seem to give inflation beating returns and also doesn't seem to be like an adequate insurance product. So what we are going to do is now we are going to look at an alternative strategy which we can use for our retirement. So in this retirement strategy, we have two phases. First, in the accumulation phase, which is throughout your working years, you might have built a considerable amount of corpus to be spent in the next phase of your life, which is the distribution phase, which is your retirement period to help you sustain. You must make the best use of such corpus to get an inflation adjusted regular stream of income. So what we are going to do is you're going to consider a certain investment strategy to get an inflation adjusted post retirement income. So for regular income, the options you can choose for your corpus are liquid fund like debt funds, SCSS, PMBVY, RBI bonds, bank and corporate deposits. So these are debt funds which you can use your corpus for regular income. So another thing is another option which you can use your corpus is to beat inflation. So this portion can be allocated to equity like index funds, hybrid which are aggressive, or dynamic asset allocation funds. So then we can refill our debt portion once in 6 years from the equity portion. So your debt balance will remain the same as you take out the interest annually, while equity might have doubled by that time. So rebalancing your portfolio at the regular interval mentioned will help you to fetch higher annual withdrawal than before. So for example, if your total corpus you have saved up for retirement is 1 crore, then you can allocate 30% of that corpus, which is 30 lakhs, to equity. So equity interest rate average is 12%. So and the remaining 70% could be allocated for debt for regular income. So 70 lakhs will be allocated for debt. So average return for debt can be assumed as 6%. So this is the tabular column that we have come up with for this post retirement inflation adjusted income. So this strategy can be, you can see the calculations for the strategy. So by following the strategy, you will get an inflation adjusted regular annual income, and this will help you to keep pace with the inflation. This is the advantage that is missing in the SBI life policy, where you get a fixed annual income throughout your life. Then what is the final verdict? Is investing in the SBI life Saral pension plan worth investing or not? The sales pitch of any annuity scheme will be guaranteed regular income for life during your post retirement period. Yes, it is a great advantage, but if you take areas like taxation, liquidity and inflation into consideration, it makes SBI policy look unattractive. There are other products with sovereign guarantee and better tax benefit available in the market. The retirees should keep in mind that not only their regular cash flow but also their tax liability and corpus should outlive them. The biggest challenge would be to build a portfolio with the right mix of various investment products. Considering the current inflation rate and the rising medical expenses, this annuity plan can't be solely relied for your post-retirement income. So it would be better if you diversify across different investments and rebalance your portfolio as and when necessary to get an inflation adjusted income during your post retirement period.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.